Dear students, today's class we are going to learn the chapter Money and Banking. In our previous classes, we have learned the concept of money, types of money, functions of money, inflation and its effects. In the same chapter, the second part is banking. Today, let us learn the concept of banking in detail. The term bank has been derived from Italian word banco and French word bank. Both these words literally means bench or money exchange table. According to Indian Banking Regulation Act of 1949, a bank is a financial institution which accept deposits from the public and lends loan to the people who are in need of it. Thus, banks are the business firms whose function is to accept deposit and lend loans. While doing so, banks make some profit also. Let us learn how do the banks make profits. Actually, the difference between interest charged on loans and interest given to deposits is the profit of the banks. For example, if the banks charge 15% on loans and give 10% to the depositors, the difference between these two is 5%, which constitute the profit of the banks. In India, the entire banking structure, that is, all the banks are controlled by the RBI, that is, Reserve Bank of India, which is also called as Central Bank of India. It was established in the year 1935. The sole purpose of establishing this premier institution is to regulate the banks in India, revise the rates of interest periodically, and supervise the banks in India. However, banks cannot be under partnership. Banks are said to be nationalized if their deposits exceed a limit. In India, nationalization of banks was done in two different phases. First one, in 1969, the banks were nationalized. There were 14 in number. In the second phase, it was done in 1980. There were 6 in number. Totally 20 banks were there. The profit of the banks can simply shown by this flow chart. The savers are nothing but those who have surplus funds or depositors. They deposit their money in the banks, and banks lend the same to those who are in need of it, their borrowers, as loans. And these borrowers, they have to repay their loans along with the interest. However, these depositors can withdraw their money at any point of time and the banks pay them interest. Types of banks in India. Broadly, banks have been classified into two types. They are scheduled banks and non-scheduled banks. Scheduled banks are those whose names have been listed under second schedule of RBI Act of 1934 and whose paid up capital is more than 25 lakhs. Non-scheduled banks are those whose names have not been listed under the second schedule of RBI Act, whose paid up capital is less than 25 lakhs. However, scheduled banks are further subdivided into two parts as commercial banks and cooperative banks. Commercial banks are classified into four types. They are public sector banks, which are under the control of the government. They are 27 in number. Now, a question arises. How come 27? Actually, 14 banks were nationalized in 1969 and 6 banks were nationalized in 1980. 20 totally, but later on IDBI, that is Industrial Development Bank of India, was nationalized, 21, plus SBI, that is State Bank of India, and its subsidiaries also come under the public sector, which have been listed in the secondary part of it. However, the second one is private sector banks. They are 23 in number. Foreign banks, they are 44 in number. Regional rural banks, which are 55 in number. The second category of scheduled banks are cooperative banks. Cooperative banks have been classified into two parts: state cooperative banks and urban cooperative banks.